Um, Usually when we talk about investing, there's this expectation of like an inescapable binary. You know what I mean?
Oh, absolutely. The classic trade-off.
Right. It's like you want safety and high yield. Well, you have to give up the massive growth. But if you want to chase those massive compounding market rallies, you have to sacrifice the steady income.
Yeah, we are basically conditioned to accept that inverse relationship from day one of investing.
Exactly. The market prices risk and reward so efficiently that sidestepping that trade-off just seems structurally impossible.
Right, because generating a double-digit yield while still fully participating in a raging bull market, I mean, that violates the basic assumptions most portfolio managers operate under.
But today, we are tearing down a structural puzzle that seems to bypass that limitation entirely. Welcome to today's deep dive, everyone. We're pulling from an incredibly detailed analysis provided by the financial show, The Dividend Desk.
Yeah, they did a really fantastic job with this one.
They really did. They did a complete teardown of an exchange-traded fund called the Overlay Shares Large Cap Equity ETF. The ticker symbol on that is OVL.
Right.
So our mission for this deep dive is to, look under the hood of OVL's mechanics.
Yeah.
We really want to understand how it explicitly aims to outperform the S&P 500 Total Return Index, not just match it, but beat it, while simultaneously paying out a 10+% yield.
Which sounds crazy on paper.
It does. So we need to figure out if this strategy is actual financial engineering genius
Right.
or simply an optical illusion masking hidden risks.
Right. And just setting the scene here, we are looking at a 5-star Morningstar rated fund, and it operates in stark contrast to the typical income-generating landscape.
Totally.
By breaking the established conventions of yield generation, this fund really provides a perfect real-world case study for you to explore the mechanics of risk transfer, and honestly, the very real impact of human psychology on market pricing.
Okay, let's unpack this. Because before we dissect how OVL breaks the conventional rules, we need to establish how the traditional income-generating machine actually works.
Right, we have to know the rules before we break them.
Exactly. So there is this massive tens of billions of dollars industry built around covered call funds.
Oh yeah, it's huge right now.
Investors just pour money into these vehicles for the steady monthly payout. But the mechanical trade-off is pretty severe, right? They
Yeah.
systematically cap your upside participation.
Yeah, that structural cap is really the defining characteristic of the whole covered call space. You are essentially selling the future potential of your assets for cash today.
I always think of it like, imagine you own a really nice single-story house in a quiet neighborhood.
Okay, I'm with you.
A developer comes along and offers you $10,000 in cash today, just to buy the air rights above your roof.
Just for the empty air.
Right. You take the payout because, well, you weren't using that empty air anyway. But a year later, the city rezones the whole neighborhood for commercial high-rises.
Oh, wow.
Yeah, property values rip 40% higher.
Mm.
Developers are buying out your neighbors for millions. But you can't sell to a developer because you legally don't own the space above your roof anymore.
It completely capped your upside.
Exactly. You secured your 10 grand,
Mm.
but you mathematically locked yourself out of a generational wealth event.
And, the sequence of returns over a full market cycle makes that dynamic just devastating for long-term wealth.
How so?
Well, if you look at any 10-year window in the market, you are going to experience a wide range of environments, right? You will inevitably suffer through one or two severe drawdowns,
Unfortunately, yeah.
and you'll experience a handful of sideways low volatility years. But your long-term compounding relies almost entirely on the 2 or 3 massive bull market years, where the index surges 25 or 30%.
And if you are selling calls against your portfolio, those are the exact years you get left behind.
Exactly. You suffer the full brunt of the down years, but you artificially truncate the spectacular recovery years.
That's a brutal combination.
It really is. Your long-term total return will severely underperform simply buying and holding the index. Because ultimately, you traded the mathematical engine of long-term wealth creation for the short-term psychological comfort of a yield.
Right. And the firm behind OVL, which is Liquid Strategies, they identified that exact mathematical drag. They recognize that capping the upside on an asset class that is specifically designed to appreciate over time is fundamentally counterproductive.
It just doesn't make sense long-term.
No, it doesn't. So here's where it gets really interesting. They don't use synthetic swaps or like opaque derivative structures to try and replicate market returns.
Which is pretty rare in this space.
It is. They simply take their capital and buy the Vanguard S&P 500 ETF ticker VOO outright. They physically hold the underlying equities.
They own the actual stocks.
Yes. But instead of selling covered calls above the market price to generate their yield, they sell put spreads below the market.
And what's fascinating here is the behavioral finance driving that specific pivot.
Oh, behavioral finance is the best part of this.
It really is. It taps into a structural inefficiency known as the volatility risk premium. You see, human beings are deeply irrational when it comes to loss.
We hate losing money.
We hate it. We feel the psychological pain of losing capital much more acutely than we experience the joy of an equivalent gain. That primal fear of a market crash drives institutional and retail investors alike to systematically overpay for downside protection.
Basically, they treat put options like insurance policies. And because the demand for crash insurance is perpetually high, the premiums on those puts stay inflated.
Exactly. The options market consistently prices in a higher probability of a catastrophic downward move than historical data actually justifies.
Meaning puts are structurally richer than calls.
Right. And the team at Liquid Strategies leverages this persistent behavioral quirk. They know the historical reality that broad market equities generally appreciate over time.
Right, stocks go up.
Generally, yes.
Oh.
So they step into the market to harvest that inflated put premium. They're effectively operating as the insurance underwriter to a market driven by tail risk paranoia.
Okay, but wait. Acting as an insurance underwriter is a highly profitable business model right up until a natural disaster hits.
Well, sure.
Because selling a put means you are legally obligated to buy the underlying asset at that strike price if the market tanks. So if they are just selling puts to terrified institutions and we get a 2008-style liquidity crisis, wouldn't the fund face catastrophic, portfolio-destroying losses?
That is a very valid concern.
I mean, it sounds like writing earthquake insurance right on the San Andreas fault and just hoping the ground stays quiet.
And that specific vulnerability is exactly what blows up amateur options traders who sell naked puts.
Right. Naked options are terrifying.
Because a naked put leaves your downside exposure virtually unlimited or, well, all the way down to zero. But OVL mitigates this through a strictly defined risk structure. They sell a put spread.
Ah, a spread.
Right. They aren't just writing the earthquake insurance, they are simultaneously buying reinsurance further down the fault line to mathematically contain their maximum possible loss.
So they sell a put to collect that inflated premium, but then they take a portion of that cash and immediately buy a cheaper put further out of the money.
Exactly. Let's look at the math from the source.
Yeah, walk me through an example.
Let's say the S&P 500 is trading at 100. OVL might sell the 98 put and they collect 50 cents.
Okay, so they take in 50 cents.
Right. Then they immediately buy the 96 put, which costs them 20 cents.
Got it. So they net 30 cents in premium.
Precisely. Now, if the market totally collapses down to, say, the naked put seller is completely ruined, they lose 18 points.
Ouch.
But OVL's loss is capped at that 96 strike.
Because they own that 96 put.
Exactly. The mechanics of that spread change the entire risk profile of the trade. The maximum loss is calculated and locked in the second the trade is executed. It is simply the distance between the two strike prices minus the net premium they received.
Okay, so in that example, it's a 2-point spread. Minus the 30 cents of premium they kept, that means the absolute worst case scenario is a loss of $1.70.
You got it. They know their exact maximum drawdown before the market even opens.
That's a huge psychological advantage.
It is. They basically construct a statistical probability matrix. If the market goes up, if it grinds sideways, or even if it drops slightly but stays above that 98 strike, the option expires worthless and they keep the entire premium.
And if a black swan event occurs and the market just tanks?
Then they absorb a strictly contained loss. But executed over hundreds of 2-week cycles, the sheer volume of harvested premium from the mathematically probable winning trades outpaces the capped losses of those rare market shocks.
Okay, building a statistically advantageous spreadsheet model is a great theoretical exercise. But the actual application of that model in a highly volatile real-world trading environment is a different story.
Oh, completely. Theory and practice are two very different things.
Right, because if the market is dropping rapidly, you are holding the physical S&P 500, which is losing value, and your put spreads are taking their maximum defined losses at the same time. You are going to underperform plain equity beta.
Yeah, we have to be honest and acknowledge that mechanical reality. There is no magic formula that completely insulates a portfolio from market gravity.
There's no free lunch.
Never. In a severe, sustained downtrend, That combination of holding the underlying equity and taking sequential capped losses on the put spreads will result in underperformance relative to just holding the raw index.
Which is exactly why the implementation of this strategy can't just rely on a rigid, passive algorithm.
Right.
A rules-based ETF that blindly executes trades every 14 days, totally regardless of market conditions, would eventually get chewed up by volatility. So how does human judgment play a role here?
Well, the analysis from the dividend desk explicitly details the human infrastructure behind the fund to address this exact issue.
Okay.
The chief investment officer is Sean Gibson, and he leads an investment team managing roughly $1.8 billion across these strategies out of Richmond, Virginia.
That's a significant amount of capital.
It is, and his background is really critical here. He spent 30 years in options, he was a market maker on the exchange floors, and managed alternative investments through the 2000s credit crisis and the 2008 financial collapse.
So he actually has the psychological scar tissue from operating in broken markets.
Yes, scar tissue is the perfect way to put it. And that real-world experience dictates a highly pragmatic approach to active management, particularly regarding early profit-taking.
How does that work in practice?
Well, the pricing of an option isn't linear. If Gibson's team enters a 14-day put spread and the next morning the S&P 500 surges a quick 2%.
Which happens all the time.
Right. When that happens, the probability of that put spread ever ending up in the money virtually disappears. Because of how options are priced, that single day's upward movement might instantly wipe out 80 to 90% of the put's value.
Wait, so they've already captured the vast majority of the potential profit on day one.
Exactly. Now, a purely passive algorithm would just sit there for another 13 days to collect that remaining 10% of the premium.
Which is crazy, because you're leaving the capital exposed to 2 weeks of headline risk and market volatility just to squeeze out a few final pennies.
It's a terrible asymmetry of risk and reward. The human oversight allows them to identify that dynamic, instantly close the trade, buy the spread back for pennies, and immediately redeploy that freed up capital into a new, mathematically advantageous position.
That makes total sense. They actively manage the time decay and directional movement rather than blindly adhering to a calendar.
Exactly. It separates them from the purely passive funds.
So the mechanical defined risk limits the catastrophic downside, and the active human management optimizes the profit capture.
That's the formula.
That explains the steady performance, but we really need to address the massive structural shift that occurred in January 2026.
Yes. The yield jump.
Because steady performance doesn't explain how a yield basically triples overnight. So what does this all mean?
It definitely raised some eyebrows.
I mean, look at the data. OVL launched with a relatively standard distribution rate, hovering around 3.5% for years. Then suddenly, the yield published on their fact sheets spiked to over 10.29%.
Right.
A jump of that magnitude usually suggests a fund manager is aggressively levering up the portfolio or, taking on toxic credit risk to artificially juice the payout. Did they suddenly start taking wildly leveraged, dangerous risks?
It's funny, a sudden massive increase in yield absolutely warrants deep skepticism, but examining the fund's internal mechanics reveals that no structural investment changes occurred at all.
Really? None?
None. The team didn't apply external leverage. They didn't alter the parameters of their options overlay. They continued holding the exact same underlying Vanguard equity fund.
Then where did the cash come from?
The only thing Liquid Strategies altered was the accounting mechanics of their distribution policy.
Okay, explain that.
Well, the actual underlying gross premium generation of their options overlay had consistently produced an annualized return of roughly 10 to 12% for the better part of a decade.
Wow, so the cash generation was actually a constant.
It was always there. But prior to 2026, the firm's policy was to retain the majority of that option premium inside the fund.
Oh, I see.
They reinvested it, which increased the net asset value, or NAV, of the fund. Investors experienced that 10 to 12% return as capital appreciation, just the share price steadily climbing.
Okay, but then what changed in January 2026?
In 2026, they recognized the behavioral reality of the retail market. Investors heavily prioritize forced, predictable monthly cash flow.
That makes sense. I mean, liquidating shares manually to generate your own income requires making constant decisions about timing and tax lots. It induces major decision fatigue.
Exactly. Getting a cash deposit every month provides optionality. You can reinvest it, redirect it to an underperforming asset class, or simply use it to pay your mortgage.
So to provide that optionality, the firm just flipped a switch in their distribution policy.
That's all it was.
Yeah.
Instead of letting the option premium pile up inside the NAV, they began paying out that exact same generated return as a monthly cash dividend.
But wait, if they are aggressively distributing that much cash out of the fund every single month, the actual share price of the ETF is going to bleed out over time, right? I mean, if a fund holds $100 in assets and pays out a $10 dividend, the share price mathematically drops to $90.
It does. And this raises an important question about financial literacy and how investors consume data on these platforms.
What do you mean?
If you load OVL into a standard price chart, like on Yahoo Finance or Robinhood, the chart is going to look highly stagnant or even negative over a multi-year period.
Right, because standard price charts are structurally blind to cash distributions. They only track the raw share price.
Exactly. When a fund yields over 10% annually, that immense value transfer from the fund's balance sheet to the investor's checking account makes the price chart look fundamentally broken.
Which is a complete optical illusion.
A total illusion. To evaluate a high-yield instrument, you must look at the total return metric that mathematically assumes all those monthly distributions are reinvested back into the fund.
And what does the total return tell us?
When you apply the total return calculation provided in the source material tracking performance from the fund's inception in September 2019 through May 29, 2026, the reality becomes extremely clear.
And that span includes the historic COVID volatility and the crushing 2022 bear market.
It does, and over that time, OVL delivered a 201.3% total return.
Wow. And meanwhile, the broad S&P 500 total return index delivered 181.9% over that exact same time frame.
Right. They actually managed to harvest the volatility premium, pay out a massive yield, and outperform the underlying index by nearly 20%.
That is wild. And that performance is net of all operating fees, right? It's live audited market data, not just some simulated backtest.
Correct. It's real, realized performance.
Okay, but generating the return is only half the battle. We have to talk about Uncle Sam.
Yes, the tax man.
The net utility to the investor depends entirely on the friction of taxes and the burden of management fees. Strategies involving active, daily options trading usually create an absolute nightmare at tax time.
They usually do.
Yeah, they generate massive amounts of short-term capital gains that get taxed at the highest ordinary income brackets. So how much do you actually get to keep?
Well, the structural tax efficiency of OVL is actually one of its most compelling attributes. The source material analyzes the monthly 19A1 notices.
Those are the mandatory disclosures that categorize the tax status of a fund's distributions, right?
Exactly. And the income stream is expected to be broken down into 3 highly favorable tax buckets.
Okay, what's bucket number 1?
The first is simply the qualified dividends generated by holding the physical S&P 500 companies.
Okay, so just the standard tax-advantaged dividends from the underlying VOO holdings. Simple enough. What about the options trading?
The second component involves the taxation of the options overlay itself. Because OVL utilizes broad-based index options rather than options on individual stocks, the profits fall under Section 1256 of the tax code.
Okay, and why does that matter?
This rule was originally designed for the commodities and futures markets, basically to prevent complex tax avoidance straddles. But it applies a massive structural advantage to index options. Any realized gain on a Section 1256 contract is automatically taxed at a blended rate, 60% long-term capital gains and 40% short-term capital gains.
Wait, regardless of the holding period?
Regardless of hold time.
So they could enter a put spread on the Tuesday, close it for an 80% profit on a Wednesday, and the IRS automatically grants the lower long-term capital gains tax rate to 60% of that profit.
Yes, exactly. It creates a powerful tax shield compared to generating yield through corporate bonds or covered calls on individual equities. Those are generally taxed entirely as short-term ordinary income.
That is a massive advantage. Okay, what's the third bucket?
The final and often largest component of the monthly distribution is classified as return of capital, or ROC.
Now, return of capital often scares investors. It sounds like the fund is just handing you your own money back while charging you a fee to do it.
It can sound like that, but in an option strategy, it is an incredibly powerful accounting mechanism.
So
if you buy a share of OVL at $20 and you receive $1 categorized as ROC, you don't pay any taxes on that dollar in the current calendar year.
Oh, nice.
Instead, your cost basis in the fund is officially lowered from $20 to $19.
So you are effectively deferring the tax burden on that cash flow until you eventually sell your position in the fund, which could be years or even decades down the line.
Exactly. That tax deferral allows the capital to compound much more efficiently in your portfolio.
Wow. When you factor in the 60-40 split on the options trading and the deferred nature of the ROC, the net after-tax yield is significantly higher than a standard income fund.
It really is.
And looking at the operational friction, the fund charges an expense ratio of 79 basis points, and that includes the underlying fees of the Vanguard ETF they hold.
Right.
Honestly, considering the transaction costs and the massive bid-ask spreads an individual investor would face trying to actively manage a rolling, dynamically hedged put spread overlay on their own, 79 basis points for institutional execution is highly rational.
It is priced very competitively for the liquid alternative space, and there's a critical confidence booster here. The alignment of interests is publicly documented. The firm's executives have explicitly confirmed they deploy their own personal capital heavily into the strategies they manage.
They have skin in the game. That always makes you feel better as an investor.
Definitely. If we connect this to the bigger picture, the utility of this instrument becomes very clear. This isn't a replacement for the ultra-safe capital preservation bucket of a portfolio holding treasury bills.
No, definitely not.
This is engineered for the growth-oriented investor who recognizes the mathematical imperative of staying fully exposed to the compounding power of the S&P 500, but who requires the mechanical and behavioral benefits of a high percentage monthly cash distribution.
Right. It allows the investor to monetize the inherent volatility of the equity markets without severing their exposure to the long-term upward trajectory of American business.
Precisely.
So just to pull all these mechanics together to wrap up, OVL maintains physical ownership of the largest 500 companies in the U.S. Rather than truncating their upside by selling covered calls, they aggressively harvest the persistent market fear of downside crashes by selling defined risk put spreads.
Right.
They deploy decades of institutional options experience to actively manage those spreads, cutting risk and capturing profits early. And they funnel that extracted premium into a highly tax-advantaged 10+% yield, all while generating a total return that has actually outpaced the raw market over a highly volatile 7-year period.
The mechanical execution of the fund is undeniably impressive. But, stepping back from the math, studying OVL's methodology leaves me with one final structural question for you to consider.
Lay it on us.
The entirety of this fund's outperformance is predicated on harvesting the volatility risk premium.
Right.
They extract billions of dollars from the market strictly because human beings consistently, irrationally overprice their paralyzing fear of a crash compared to their mathematical probability of a gain.
Because we hate losing.
Exactly. So if a fund can build an entire alpha-generating business model simply by monetizing human panic, how much of your own personal portfolio's underperformance over the years hasn't been the result of poor asset allocation or bad math, but simply the cost of surrendering to those exact same behavioral fears?
Wow. We spend so much time worrying about the catastrophic downside, we end up willingly selling off the very air rights that guarantee our long-term growth. It completely reframes how you look at the cost of safety.
It really does.
Incredible stuff. Well, thanks for joining us on this deep dive into the mechanics of OVL.